There is an ETF strategy that millions of investors use every single day. It looks safe. It feels responsible. Every financial advisor seems to recommend it. But under the surface, it's quietly destroying returns for the people who trust it most. Let me show you exactly what it is and what to do instead. The strategy is called the 60/40 portfolio. 60% of your money in stocks, usually an S&P 500 ETF. 40% of your money in bonds, usually a bond ETF like BND or AGG. The idea is simple. Stocks grow your money. Bonds protect it. When stocks crash, bonds go up. Perfect balance for decades. This was the gold standard of investing. Every textbook, every financial advisor, every retirement plan, 60/40. And for a long time, it worked beautifully. But something changed, and most investors haven't noticed yet. In 2022, something happened that most investors said was impossible. Stocks crashed. The S&P 500 fell 18%. And bonds? Bonds were supposed to go up. That's the whole point of the 60/40 strategy. Instead, bond ETFs like BND lost 13% in the same year. Both fell at the same time, for the first time in over 50 years. The classic 60/40 portfolio lost around 16% in 2022. One of the worst years for this strategy in modern history. The protection that investors were paying for didn't work. So what happened? Why did the safety net disappear? Here's the explanation, and it's simpler than you think. Bonds and interest rates move in opposite directions, always. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. For 40 years, from 1980 to 2020, interest rates were falling. So bonds kept going up. The 60/40 strategy worked because rates were in a long downward trend. Then, in 2022, the Federal Reserve raised interest rates at the fastest pace in 40 years to fight inflation. In just 12 months, rates went from nearly 0 to over 5%. Bond prices collapsed, and they took 60/40 portfolios down with them. The strategy didn't break because it was poorly designed. It broke because the 40-year tailwind that powered it finally reversed. But wait, even before 2022, the 60/40 strategy had a hidden cost. Let's compare two investors over 20 years. Investor A puts $10,000 into a classic 60/40 portfolio in 2003. Investor B puts $10,000 into 100% VOO, the S&P 500 ETF, in 2003. By 2023, Investor A with 60/40, around $41,000. Investor B with 100% VOO, around $67,000. The 40% in bonds didn't just fail to protect in 2022. It dragged down returns for the entire 20 years. Now, to be fair, Investor B had a scarier ride. In 2008, their portfolio dropped 50%. In 2020, it dropped 34%. Investor A only dropped 25% in 2008. So the question isn't which is better in theory. The question is, which can you actually stick with when things get bad? So what should you do instead? If you're under 40, seriously consider going 100% into a simple S&P 500 ETF like VOO. You have time to recover from crashes. The math strongly favors full stock exposure over long-time horizons. If you want some protection, consider updating the 60/40 to an 80/20, 80% in VOO or a total market ETF, 20% in short-term bond ETFs like SHY or SGOV, which are far less sensitive to interest rate changes than long-term bonds. The key insight is this: long-term bonds are broken as a hedge in a high-rate environment. Short-term bonds still work. And if you're close to retirement, that's a different conversation entirely. Your timeline changes everything. The bottom line: don't blindly follow a strategy because it worked for the last 40 years. The conditions that made it work have changed. Your strategy should too. Nothing safe stays safe.